Welcome to Value Investing webinar once again. Today we are going to talk about behavioral traps investors must avoid. Investing is a lot of hard work, but after that, the way you conduct yourself, the way you respond to the market madness, the way you think irrationally, some of the biases which is very human, the way we respond to losses, the kind of irrationality that creeps in when you see the investment values crumbling in no time, the free fall of the market or the big surge, and the way we conduct ourselves, the way we respond to that could be one of the big differentiators, the way whether you succeed or not, whether you succeed or fail. So to discuss and understand all the problem that the way investors conduct and the kind of problem or the impediment it is to make market as a useful vehicle to grow your wealth. With me is here Nilesh Shetty from Quantum Mutual Fund to discuss the kind of things which you'll be struggling every day.
Yes, day in and day out.
So how much of it is, how biased are you?
All of us are, unfortunately, all of us are. I mean, there is enough research now to suggest that within us there are two systems broadly. One is the rational and reflective self. It sort of looks at the data and then takes a very rational decision. And the other is a very instinctive and sort of the animal instinct within us, where we developed certain rules of thumb when we were evolving. So it helped us when we were evolving, but it also now causes certain behavior which causes or forces us into traps, which perhaps
causes you to misbehave.
And causes us to misbehave. And now there are enough experiments to prove that we
Just
consistently.
Give me an example for our viewers to understand.
Yeah, so let me take a very simple example. Now, Robert Cialdini in his book Influence had put out a concept of crucial proof. Now, we as humans, whenever we go into a new environment, how do we know how to behave? And what we do in that scenario is we look at others around us, and how they behave is how we assume is what we should behave. That is called social proof. Once you see others doing it, that is how
aligning with others.
Yeah. Now that behavior, that rule of thumb works in most cases, but in markets it does not. That is what sort of causes herd behavior. If everyone else is buying a particular kind of stock or buying a particular theme, that you assume that is what you are supposed to do.
Must be right.
Yeah, and that is what you end up doing, which causes this euphoria and bubbles in markets. So that rule of thumb works for us in most cases, but in certain market environments,
other dimensions of life, but not necessarily in markets.
Not necessarily in equity markets.
So there are many theories which relate to success in investing, on the psychology, how we conduct. Charlie Munger, once mentioned that human psychology is as important as economic.
Yeah.
So, what are your views on that? How do we actually look at it?
Yeah,
sense of it.
Yeah, a lot of investing is just trying to ensure we do not make mistakes while investing. Because of this instinctive self that we have, and because we sort of tend to borrow so much from what others are doing in the markets, we tend to do a lot of mistakes. And most successful investors, if you sort of look at how they've built wealth, they've been able to minimize that part of their investing in terms of how the lesser the mistakes that they've done, the better they've done over a period of time. And a lot of it is just controlling their behavior. In euphoric markets, just controlling and stepping back, being patient with their investment and not sort of panicking after investing into a stock and if it's fallen a bit. So a lot of it is just trying to control your sort of instinctive behavior.
Managing your emotions.
Yeah, and so there is now enough data to suggest that there is a real sort of science there, and if enough experiments to prove how we misbehave all the time.
And there's a basis to it.
Yeah.
Okay, we have just listed 4 or 5 things, and I would like to understand, possibly with your real life example of conducting in the market or being in the market for a long time. Loss aversion. How do you explain it?
Yeah, it's
understandable.
Yeah,
something you bought it at 20 comes down to 15 and you get scared.
Again, it's a lot of it is linked
to... How do you overcome this?
Yeah, a lot of it is again linked to evolution. Because of the fear of pain that was inbuilt in us, we sort of avoided a lot of the things which sort of others did not, and we sort of evolved and survived the evolutionary phase. So this entire thing of losing money triggers that pain sensation within our brain, and which is not something we want to experience, and which is what we've avoided throughout our evolutionary period. What it also means is once we have seen a loss in our stock, and even though our rational self is telling us that perhaps this is the time you should exit that stock, but because you will experience that pain of the loss, we will not exit. We will continue to hold it.
Okay.
So it leads to two behaviors. One is avoiding certain investments because we fear a loss, and second, once we've had a loss, just rationally when we should exit, we do not exit and we continue to hold it for a long period of time.
How do you deal with this?
Again, you go back to basics in terms of, and at least for us,
it's worth it.
Yeah, we go back to and what is the reason we bought into this stock, and whether those reasons still hold. And irrespective of whatever loss we are facing right now, if those reasons have changed and they are no longer valid, then you have to force yourself to exit and just look at other alternatives.
You just talked about, the confirmation bias.
Yeah.
And so that's a confirmation and availability bias.
Yeah.
How do you explain the availability bias? People look at data, they see that, okay, this is historically has been like this, and there are reasonable, looking like, there's reasonable evidence, and then you think that you're good to go.
Yeah, I mean, availability. So again, I don't know what causes that behavior, but again, availability bias is if you read the news, I mean, you have all these terrorist attacks and other things, and you ask a person what is the probability of you dying of terrorist attacks, he will rate that probability very high because he reads it so often in the news. But real life probability would be very, very low for him. Just because it comes in the news so frequently, you tend to place a much higher emphasis. So because the news is available in front of you all the time, you tend to misallocate sort of probabilities to events because of that. Similarly in research, if you have data in front of you and around you all the time, you tend to place a much higher emphasis on that available data rather than looking at data points which actually tell you that
could be more relevant. So you just base it on the things that you know.
Yeah, or that is more in front of you, available to you in that sense, which causes you to sort of misallocate capital.
Just give me an example of how it actually distorts your understanding or your bias, your impression of a stock.
Yeah, so a very simple example could be a company is reporting very good sales. Somewhere along the line, you know that this number is perhaps not sustainable, and there are things happening around that company which perhaps could lead to this company's profits to be lower. But just because the near-term numbers are so great, you tend to place a much higher emphasis on those numbers and then value the company based on that, rather than looking at the slightly longer.
So recency guiding your thinking.
Recency, because again, recency is sort of linked to availability. Because you have that data in front of you right now, you tend to sort of place a lot more emphasis on that data than to look at sort of other data points which should have guided your decisions.
But that is very normal, we remember what happened yesterday than what happened 1 year ago.
Yeah. So, but that is an inbuilt bias in that sense. So you have, because again, it's also linked to...
We would think that, it is more likely to repeat what happened a few days back.
Yeah, but again, it's also linked to brain drain, because we have so much stimuli coming into our brain. We tend to evolve shortcuts to make decisions. And one of the things is if this is the data, I don't want to do a bit more effort and get more data. If this is data, I'll just go with it, and then I will just sort of make investments based on that. In hindsight, you will come to know that perhaps you should have looked at other data sets to confirm that data. But right now, because you had just one or two data sets in front of you, you depend on that and then make your decisions based on that.
Next one is, investors fall in love with the stock, with their stock.
Yeah.
First, tell me your love story. Which stock you fell in love with and it turned out to be bad?
So very recently, there was a sort of large commercial vehicle company that we owned in the portfolio. After we bought it, sort of went up a lot and we felt like geniuses, and then sort of events unfolded in the business of that company where we should have reacted a lot quicker. But because originally it had done so well for us, we kept on sort of waiting, and the stock kept on falling. And sort of we believe, no, our research is right, and no, we believe that the company will do well. But at some point we realized we are sort of holding on to the stock for the wrong reasons, because the original thesis had completely changed. So
4 of you fell in love with it together?
Yes, we did, unfortunately.
And all kind of brainstorming did not really come up with...
Again, we kept on giving time to that investment. We thought that things will turn around and will change around, but unfortunately things just kept on getting worse. And at some point we realized that's why 4 helps, not 1. So some people then, at least in the team, started realizing that we are probably not taking an action that we should have done 2 years ago, and it's time to undo whatever sort of damage that has happened in the portfolio.
So how to overcome this?
Again, you have to just go back to basics.
Change your mind.
When you, whatever a good thing to do is, whenever you've bought an investment, just write it down. What is the reason why you brought
that's
this
still in
investment?
place.
And you just go back and check whether those reasons are still in place. And if the reasons have changed, then you have to force yourself to essentially exit, irrespective of whatever genius you think you are in terms of analyzing.
How to overcome this herd behavior? I have seen it, time and again. 93, 2008, 2004, 2008 once again, the infrastructure boom. Not very long back, 2 years back, people got excited about a certain set of companies. Everybody was buying as if, they're going to miss the bus. How do you do this? Because, it actually, herd behavior helps to begin with. You make money. And everybody is making it.
Like I said, because we are so strongly linked in terms of trying to borrow from others, in terms of what is the right conduct, just because how we evolved.
Herd and confirmation bias, they come all together.
And so it's actually very tough to undo. I mean, all sort of herd behavior, there's always an underlying story initially, and then it becomes so expensive. So and then over a period of time, it sort of
goes out of hand.
And in the markets, not just the company, the price that you pay determines so much in terms of what kind of returns that you make. So it really, at some point, you have to just step back from whatever environment you are in and move away, and then do a real sort of check in terms of what is it that you are buying into, and whether that story does it still hold. I mean, a lot of this herd behavior comes from seeing others do well and you're missing out, and you're just observing, and it takes a long while for that thesis to come through, and all that time you look like a fool, and to be able to handle that is a very tough thing for us, like value investors in a bull market, to stay back and then not invest and listen to all the investor feedback saying why are you underperforming in a bad way in a bull market is a very tough thing. But again, you have to just go back to basics and tell yourself, this is very expensive right now, I will not invest, and there's a high probability of losing money in that kind of markets.
So having your own framework and being comfortable with the thought that let people call me fool, I'm fine.
And develop a thick skin, because the markets might take a long time to correct or come back to rationality, and in that period of time you have to sort of listen to all the feedback that you're getting, but be strong about your convictions, and just again go back to the rational self. What is it that I'm buying into, and whether it's worth it. If it's not worth it, then step back.
In this whole process, this chasing trends, what has happened in recent times, and some of the trends actually continue for a while. So and you will be looking at confirmation, you will be looking at validating the hypothesis if it's real. How much of an opportunity loss all this, being good, this good conduct is fine, being objective in your evaluation or your decision making or rational thinking, but chasing trends, and some trends can just go, everybody was apprehensive in the early 90s about the technology companies, and it's a trend and it's a new thing which came up and it turned big. All kind of apprehensions were there that these are companies which will just disappear simply because they don't even have assets, they just have computers. It depreciates so fast, and a services company of this scale that came up. So early gains in those companies is something which would have been very valuable.
Unfortunately, most of these sort of disruptions are not that easy to pick. I mean, it's only in hindsight that you come to know. And rightly, even in the tech boom, majority of the companies disappeared. They did not survive. Only the very few quality names did survive. But the underlying sector did really well. There was a genuine disruption which happened.
We had no industry. And now it is one of the sizable industries.
That is correct.
And we have, last 18-20 years, we have been able to create, in fact, India's largest capitalized company happens to be one. Infosys, Wipro, HCL. If you combine them, then it will be a very sizable part, and has seen uninterrupted growth. But if you actually cut short the initial 10 years when all the magic happened, then it looks like a great missed opportunity.
But again, so I think Charlie Munger calls it the Lollapalooza effect, where 3-4 factors combine and then you get that kind of magic happens. where for a layman it's actually very tough to figure out, or even for experienced investors it's very tough to figure out in that environment. So in the case of IT, I mean, a large sort of engineering base, falling cost of internet to do business overseas, and then sort of opening up of India in that environment where you could get access to forex to go abroad and come back, and just the lease line, the internet lease line, the cost at which it was falling, sort of gave such a big fillip to that industry, right? So I mean, so many factors combined to create that trend. So it's very difficult for experienced investors to figure out that this is going to happen.
Anticipate all
a lot of the times it does not happen. So you think there is a trend and something is emerging, and failure rates are very high. The very few time it does play out. You really have to be lucky in that sense. You can sort of sit back.
Tell me, how do you go about spotting that you are trapped in some your own bias? How do you go about, because it's self-correcting. You have to introspect, think hard, and then come up. Do you have a checklist? What kind of debates do you have to spot this?
Again, for us, when we sort of buy into any investments, I mean, we have sort of the fundamental thesis ready. And at some point in sort of environments where it becomes crazy, you have to keep asking, are you buying into the company because there is genuine earnings growth and because the underlying business is gaining traction, or you're buying a company hoping there is a greater fool who will buy the shares from you? If it's the latter, then that is when you step back.
Yeah, I was just writing my last week's column and I was talking about WeWork's IPO, which is, pretending to be a technology company, and it's a real estate company, and that too absolutely nonsensical, and trying to look for all kind of bigger fools.
So I assume there at some point people who sort of came in between and valuations went up, they thought they were geniuses. Unfortunately, now it's sort of come down quite rapidly.
No, maybe it gets cancelled, and some of those wishful thinking just turns out to be wishful thinking. Tell me some more examples, because our viewers will actually benefit from your examples in terms of how you got trapped and how you got rid of them. And tell me the real example, old one, which is regulatorily compliant. People can recall those.
Yeah, so I mean, we used to have this IT company called sort of 3i Infotech in the portfolio. Again, it sort of used to supply software for asset management companies and other companies for their backend. Again, and we were one of the users of the software.
Customers.
Yeah. So I mean, we liked what they were doing, and again, it was owned by ICICI Bank at that point in time, and it was doing really well. And we bought into that company in the portfolio, and of course it initially did well, and then in that entire pre-Lehman phase it sort of borrowed for growth and acquired a lot of companies. And once Lehman collapse happened, a business came down and the debt remained on the books, right? And how do you start servicing the debt? And then even though the P&L looked fine, the balance sheet started getting into a lot of trouble for this company. And we should have perhaps exited that investment a lot earlier. But eventually, I think we sold it at sort of 80 or 85% loss to our investment value. And so again, that was again one of the things was loss aversion. You kept on meeting the company and they kept on telling you how fine they were doing, and you then
just looked at the P&L.
And you looked at how big a loss you were going to book in that investment, and if the company is going to improve, perhaps you should give it time. And we kept on delaying that, and eventually we had to book it at a big loss, realizing that this is not going to happen. It's getting worse and worse for this company.
So now we get on to the questions. We haven't got too many questions for the behavioral traps investors must avoid. Few of them. Isha Mehta is asking, what are the key points you would recommend to a beginner to go through in an annual report of a company, and why?
Yeah, so I assume a beginner who's never seen an annual report, I mean, the annual report is actually a very good document, sort of classified in different sections. Perhaps the first thing that you need to do is perhaps read, there's a section called management discussion and analysis, where the management lays out what the business is and what their plans are and where they see the business is going, just to understand what this company is about and where they're heading for. Then you have a document which nobody reads, unfortunately, the auditor's report, just to check whether the auditor has pointed out certain things in the annual report or in the financials of the company which should worry you. And then you have the financial section. A lot of people pay a lot of attention on the P&L and very little attention on the other two statements, which is the cash flow and the balance sheet. My suggestion is to focus a lot more attention on the cash flow of the company and more on the balance sheet, because profit and loss can be managed by most companies. What they tend to do is sometimes
What do you mean by manage?
Yeah, so if I'm a consumer, say a consumer staples company, I want to show a certain revenue number, I can dump my inventory onto dealers and I can book them as revenue, telling them that you can pay me later on. So he has generated revenue, he has booked, he's reported margins on that and reported profits on that. But if you look at the cash flow, you will see him sort of showing high debtor days and sort of a very expanded credit period in the business, where he's financing all these debtors. So he's shown revenue but not cash flow in the business. So that is where you see companies managing their P&L.
Just for the benefit of our viewers, I would like to explain this, that profit and loss account of a company is reported on an accrual basis. You don't have to get the money in the company to report the sales number. You have sent the stuff and you have assumed that this is sold and it can come back, but in your accounts you show that this has been the sale and the corresponding profit. So the cash flow statement will be able to catch that if the money has, something has been sold or reported as being sold, but you have not realized the money, it is a fictitious thing and it will come back to haunt you. The other thing from this year, what you are saying at the outset, that people don't read the auditor's report. From this year onward, the auditor's report is going to become richer because the circular, the guideline has been changed. Auditors are expected to, or you're supposed to do a far more rigorous reporting on the state of the financials or the kind of things. Earlier it used to be just listing some of the broader things and signing it off. From this year onward, it is far more rigorous in terms of, I see the auditors at Value Research getting very intensely into things in terms of validating that they want to really see that all the claims being made by the financial accounts, they want to look at the evidence of it. Also, we have far greater accountability in terms of sales being reported because GST has to be paid. So earlier you could sell something and it can come back. There could be a sales return, but now you have to pay taxes. Yeah. So it can't. Things are becoming better in terms of accountability and veracity of the numbers that we see in the annual report.
Yeah.
So start learning. It's great fun learning how to read annual report, and if you start enjoying it, nothing like it. You will end up being a good investor. Abhinav is asking, when we say value stock, is it on the basis of ROE or PE ratio? Now this comes in a very unusual, it's far more complex.
There is no
much more
there is no shortcut or there is no basic 2-3 parameters which defines value. I mean, value in the eye, sort of every investor will have his own sense of value for the company, and then a value investor will have a discount to that value. But there is no rule of thumb, because we look at multiple factors when we are looking at sort of banking stocks. We are looking at price to book. In consumer staples, we are looking at price to earnings. In a lot of the commodity companies, we are looking at replacement costs, the cost that is required to set up a similar facility. Cement companies, and even a lot of the oil refining or oil marketing companies. Yep. So there is no one set rule for value as such.
Makarand is asking, while investing in a value fund, would you recommend going through the SIP route or shall we invest in a lump sum? Maybe I'll just answer it quickly. While investing in a value fund or any equity fund, always invest, if you're earning every month, the SIP is more of a habit, should be more of a habit, and it just aligns with your income cycle and other things, and long-term money should be invested. If you have lump sum money and you want to invest, you can consider a value fund, but even in a value fund, I would say that depending on the kind of the scale of money that you have to invest for lump sum, or you have available to invest for lump sum, I would say to manage your own emotions, to manage your own behavior, to manage your own reaction to what will happen soon after you invest. It is always good to be spreading your investments over some time period, 6 months to 1 year. There is no basis to a rule which I follow, which is invest the money in a time period, half the time period as it has taken for you to earn that much. So typically, but never exceed more than 3 years, because 3 years is a good enough time period, because then you'll say that if I have accumulated all this money for my retirement somewhere, and it has taken 30 years, so you can't spread that investment over the next 15 years. Do it over 3 years max, and so this will just bring in some kind, and there is no basis to it. I'm just saying that it brings in some discipline, your emotions are in check. Syed Qureshi is asking, do you think restructuring GST and fixing a low rate for all goods and services tax will energize the market?
I know the companies will feel a lot happier if GST rates come down. I don't know.
So do consumers,
Yeah. But I don't know the government of India's finances can handle that. I think.
I don't know, because it's a fairly elastic situation. Government just might end up earning more revenue if consumer gets excited about if the price points become different and it suddenly triggers some superior consumer confidence in the consumption.
Possible, but it might come with a lag, not immediately. There'll be immediate hit on the government finances, but eventually I think it has to be a lot more simplified than they have right now. I think that is what the experiences of other geographies who have successfully implemented GST. The rates of taxes, either 1 or 2, they don't complex with 4 layers of taxes.
But I also feel that it's way too high, because compared to all other geographies. Complication, because India is a very complex country. You have a lot of stuff still in the zero, and the 5% is reasonable. All the food items and other things. But when it comes to services, everything has gone up from Pranab Mukherjee's time of 10% to 18%.
That's correct.
So that is something which is, it's almost like on my turnover, 1/6 goes as by way of GST. So 18% effectively means that, and that's a flat thing. It happens also for your AMC, and there's no way to escape that. Alok is asking, what is a favorable PE range, multiple range for small and mid cap index, where investors can make around 18 to 20% over a 3 to 5 year time frame?
Yeah, so again, we've never looked at the index multiple to decide. Every investment has to be like a stock specific investment. The lower the better. I don't have a number there for a PE as such. I know the long term for the sort of larger, the Sensex has been about 17 or 18 times. The smaller companies, I'm not so sure. What the long term multiple is. But I would never advise investing based on price to earnings of indexes.
Yeah, because index is an aggregation of a variety of companies. It could be 30, 50 companies, and there could be stocks which will have no earnings, so no PE, and a very low price earning ratio, and some of the outliers which can actually completely distort it. So what you see as the aggregate of the index PE might be a misleading thing. But PE is actually, get guided by the growth and your belief in that. There could be a very high PE and it could be very well defendable, and it can be profitable to be investing in those companies if those numbers, the growth is sustained. If you have a low growth company and you are paying a high PE simply because it happens to be a great management, good story, it will disappoint you. So it's all subjective. You will have to soil your hands. You have to get deeper into things, and specifically to companies. I'll just take the last question, which is Rajendra Babu is asking, when do you expect the market to revive? Will Diwali happen post Diwali?
I don't know. I don't have such a short-term view, but I think a lot of the companies are looking forward to.
But I don't mind having a gift before Diwali. Let's take a bet on that.
Yeah. In terms of whether the markets will revive.
How will market be excited before Diwali? For fun.
I doubt that, given the environment.
That may not happen.
That may not happen. I think given the environment that we are in, I think it might take a bit more time for the market to survive.
Thank you very much, Nilesh, for being here, and it was an interesting discussion today. Come back again next month.
Mutual fund investments are subject to market risk. Read all scheme related documents carefully.